Platinum Top 50 Austin, we heard your calls. Appraisals and lending. You asked for it, we are delivering it. So I know that our community has been asking for us to cover this topic because there's a lot of questions out there regarding appraisals and lending and how this is factoring into our current economic conditions. And so I couldn't be prouder of the panel that we have put together to help you tackle this issue. A few of the highlights that we're going to cover, so just a little preview. Value adjustments during a market shift. What's a proactive approach to best make value? How do you assess value for some of those unique features like pools and solar panels? Or what's advice on preparing for an appeal of an appraisal? And so that's just a little bit of a preview of the conversation that is to come. As a little bit of housekeeping, because I know as we go through this panel, you guys are going to have questions. And so I just want to remind everyone that at the bottom of your screen is a chat bubble, and you can use that to send me questions. I'll make sure we've allotted Q&A time at the end. I'll make sure that I get your questions answered and directed to the right people. Because I don't take for granted that you have given us your time this afternoon, that you're welcoming us into your homes or your personal space. And so I want to make sure that we get answers to the questions that you have most. And so keep in mind the chat bubble. Also, this presentation, the time that went into assembling the panel, marketing this, getting this out to you, is one that is being brought to you today by our partners at Legacy Mutual Mortgage. I am grateful for this partnership. It's one of the longest standing companies that I personally have worked with, spanning over 10 years. And so I just couldn't be more grateful that they said, you know what, absolutely, Amber, let's take that online and we want to be a part of it. So thank you to Legacy Mutual for your support, not only today, but in the past and in the future as well. So on behalf of Legacy Mutual and two of our panelists that are going to be having this conversation today, I would love to introduce you to Josh Penland. Josh, are you there? Can you join me? Josh, so I'd love for you to introduce yourself to the audience in the off event someone doesn't know you, which they all probably do. And then if you don't mind introducing Nick, that'd be awesome.
Great. Thanks, Amber. So again, thanks for letting us do this today. It was awesome. Great topic. I'm Josh Penland. I'm with Legacy Mutual Mortgage. I've been a loan originator in Austin for almost 17 years. So I've been with Legacy for 4 years. So yeah, you know, just we're seeing a lot of different changes and things happening due to COVID, and I just think this is a very important topic for us to talk about and share. And so with me, I also have Nick Pronsky, who's also a loan originator. Nick, you want to introduce yourself?
Bless us with your presence, Nick.
Hey everyone, my name is Nick Pronsky. I'm a mortgage loan officer with Legacy Mutual Mortgage. I have been in the mortgage business for almost exactly 15 years now. I started in the wholesale side of things. I've worked as a processor, an underwriter, a loan officer assistant for 4 years, and I've been originating full-time in Austin for about 9 years with Legacy for 5 of those. And so really appreciate you having us on today, Amber. I think it is a really important topic to address right now and something that everyone can educate themselves on and become more familiar with to help them better their business.
Awesome. And just to let the audience know too, like we've had prep calls and practice sessions, not only with Josh and Nick, but also with our 2 other panelists. And they have really put a lot of time into making sure that they're available to answer the questions you have. And so when I said in the chat right here, buckle up, you're in for a great program, I mean that. So I am going to introduce our next 2 panelists, and then I'm going to duck out because I actually don't add much to this conversation. I am not a loan originator. I don't know anything about appraisals, and I'm not an active agent. So other than just sit here and host it, my part is almost done for this. So with that being said, I would love to introduce our 3rd panelist. So Lauren Reeves is the president of Appraisal Shop. I'm sure a lot of you are familiar with Appraisal Shop, and he has a lot to say on the topic and is really, really open. So this is going to be awesome. So Lauren, will you please introduce the audience and tell them a little bit about your professional tenure?
Thanks, Amber. I'm Douglas Lauren Reeves. Some of y'all know me as Doug Reeves. JJ and Josh and Nick call me Lauren. So I have a company here in Austin. We're an appraisal firm called Appraisal Shop. We have about 25 to 30 appraisers, and we do a lot of the work here in the Austin area.
Awesome. That's great. And again, because I've had a preview of the conversation, I just really appreciate your openness. And when people said, well, could you talk on that? You're like, absolutely, all day, every day. So I just appreciate that. And thanks for being with us. All right. So rounding out this panel of gentlemen, to balance it out, Nicole Marburger. Nicole is the broker associate with Legacy Real Estate Group with Compass. And Nicole, I'm going to let you introduce yourself. And then, like we said, you're going to kind of take it away. And I'll be here for support. Again, to our now 75 participants actively listening, don't forget to chat with me. Use the Q&A bubble at the bottom. That way we can make sure that we get answers to your questions. So that's it from me, Platinum Top 50. I'll see you at the end. Nicole, I'm turning it over to you, and good luck with these guys.
Thank you. I'm Nicole Marburger. As Amber mentioned, I am with Legacy Real Estate Group, powered by Compass Real Estate. I've been in the industry going on 5 years now. I've done a ton of work with both Legacy Mutual Mortgage as well as Lauren's company, the Appraisal Shop. So we're excited to share their knowledge with you as I moderate the conversation. So we'll hop right in, because I know that everybody right now balancing working from home and our busy schedules, you want to stay on track. So you'll have to excuse, I have a couple of notes here to make sure that we do stay on track. So Lauren, I want to start by talking about COVID-19. Obviously, it's what's filling everybody's airwaves right now, but we just want to touch on it on the beginning and get it out of the way. At the beginning of this, I saw some conversation in different real estate forums of everybody get ready. The appraisers are about to start docking appraisals X percentage because there's a potential market shift coming. So could you talk to us about that, and if that is in fact true or a myth that you could debunk for us?
I would say that that is a myth, that it would be the only way that would happen is if the comparable sales themselves begin to show a decline. So we're always going to use the comparable sales. We're not going to use some sort of idea that it's going to go down or try to predict that and then add that to the appraisal. So we do have the market conditions addendum that you all should look at in the report. It's a one-page addendum that shows the trends of increasing value or decreasing value. But we would only do that if the comparables themselves are indicating that. So as long as you have good sales, which we continue to have in Austin, and we've seen some of the highest sales ever recently, actually. So I don't see that that's going to be the case. If that moving forward, we start to see a decline in value, I don't know why we would. We still have a severe undersupply. So.
Perfect. Well, I know a lot of agents are happy to hear that right now, myself included, because it's always scary, especially myself personally and anybody newer to the industry that hasn't been in a recession before. We don't know what's true, what isn't true, and how appraisers handle these situations. So thank you for answering that. Josh, could you maybe touch on the difference between an appraisal management company versus an appraisal firm and why that difference is so important?
Yeah, sure. So, you know, we've worked with Appraisal Shop for, gosh, probably over 15 years, almost my entire career. And I really get to see the value of an appraisal firm when I have to go and do an appraisal in a small community. So AMCs are appraisal management companies. They're typically national companies that have, you know, hundreds of appraisers that are contract appraisers. Typically, they're coming in, you know, they do the appraisal at a much reduced fee, because the AMC has to take their cut. So we have to deal with AMCs in smaller communities, other markets that we don't normally have Appraisal Shop. The big difference, there's several, but I think the main ones are Lauren's appraisers are W-2 appraisers. They all go into the same office. You know, they all collaborate and share together. You know, they've all been, I mean, I think you said you had what, how many, 25 to 30 appraisers? I mean, I usually tell them, you know, their appraisers really, you know zip codes, they know the area. You know, we're not going to have someone that lives in San Antonio doing an appraisal in Cedar Park. So to me, there's that piece that I feel like we get much better quality appraisals is really the big thing. And then the other thing is just the relationship and the conversation we have, which we'll probably talk about later with Tidewater, being able to have conversations ahead of time if there's any value concerns. With the national appraisal management companies, that doesn't happen. So have we all gotten an appraisal and that misses value by 30 grand and no one even knew it was an issue? And then once you get this appraisal back, you're trying to fight the value, you know, after the appraisal's been certified. It's very difficult to do that. So having Lauren and his team, you know, reaching out ahead of time is such a huge piece. And we'll, like I said, we'll go over that here in just a few minutes.
Perfect. Yeah, thank you for sharing that. I definitely personally have experienced working with out-of-town appraisers and having to talk to them about our market and how quickly things can appreciate versus working with the local appraisal shop and how smooth that process is. And I am excited to jump over to that in a little bit too, how they handle things proactively. Well, Lauren, I do want to ask you another thing too. One of the most interesting things that's happened since I joined real estate is the new addendum, which is the right to terminate based on the appraisal. And so I'm excited to talk about how does, you know, provide your thoughts on this addendum, maybe to start us off.
So when that first came out, I took a class from Kevin Scanlon about it. He's the president of ABOR. His ideas about it was that it was a very bad document for the buyer side to be signing. So I don't, you know, I understand as a listing agent, you want some assurances. I think that if the worst thing that we've run into would be something that's out of the option period, that the buyer's agent is just sure should appraise, and perhaps the buyer has been told to sign this document and that they're going to pick up the extra 20K in cash based on an assurance that it should appraise. And that just isn't going to happen. And I think that's the worst case scenario. It would be better to have a longer option period, get it over to a firm that can get it to you during the option period, because then you have kind of the best of both worlds. You can sign it and be in the option period. But if your buyer is not ready to pick up every bit of that difference, I think it's problematic.
Yeah, thank you for sharing that. It's such a serious document, and my team and I, we really try to go in depth when talking to both our buyers and our sellers about the 3 options on that document and the potential worst case scenario risk. So Nick, I want to jump over to you and ask, as a lender, have you been put in any unique situation where possibly it wasn't explained to the buyers up front, and then it does become an issue and they need to make up a shortage and you have to be the person to explain it to them?
Yeah, well, I mean, it's not often, but there are some times where they don't have a full grasp of what they've signed. And so from a lending perspective, you know, that's one of the first things we'll look at when we have the initial conversation about their rate lock and loan terms. And we'll look at, okay, so you did sign this form and it says full waiver, partial waiver, whatever that may be. So let's upfront talk about some what if scenarios. What is going to happen to your financing if an appraisal comes in low? So we can have that conversation and the buyer is going to be prepared. I think the most common misconception about this form from all angles is that if an appraisal comes in low, the buyer has to bring the difference between the purchase price and the value in cash at closing. And that isn't always the case. It's not period, end of story. So that is the case if the client is doing the minimum down payment. So if they're doing a 3 or 5% down loan and it comes in low and they sign that waiver, yes, they do have to bring that cash difference. But if the appraisal comes in low, all it really does for those clients that are putting 10%, 20% down or more, all it does is affect our loan to value ratio, because we calculate the LTV based on the loan amount compared to whichever's lower, appraised value or contract price. So if an appraisal comes in low, it doesn't mean more cash out of pocket necessarily. It means us restructuring their loan terms. So that can mean, as an example, if it's a $500,000 house and they're only borrowing $300,000, if the appraisal comes in low and they sign that form, it doesn't affect their loan. The price is still the same, the loan amount is still the same. So their cash to close and monthly payment is still identical to how we started. But if they're putting 20% down, looking at a LTV above 80, so we might need to add PMI to that loan as opposed to them bringing the difference in cash. So it's more about restructuring the loan. And I think that's a big misconception, is a lot of clients and realtors just automatically think, oh, it's $10,000 low, my cash to close just went up $10,000. And so that's not necessarily the case. It's more about educating the client on all their options. We can show them, yes, you can bring more money and have a lower payment and keep the same terms. Or in some cases, it's a very minimal impact, or maybe the PMI goes up $15, $20 a month. It's usually pretty minor.
Perfect. Yeah, thank you for explaining that. And I actually just went through this week with Josh on a deal, and it's so good to have a lender that knows the options and that can run through that with clients and tell them, you know, in the scenario this week that I had, it was a less than $20 difference monthly. And so it worked out great. And having those options, I think that for me personally, talking to the client on the front end and looping a lender into the conversation to talk about the what ifs is really important. So from an agent perspective, I just want to expand on that a little bit. I just saw one person thank us for this topic, so I just want to dive in a little more and share that in our conversations prepping for this, we really think that setting the expectation for your buyer is key above all else. And so if you're not comfortable with that discussion and you don't know what that's going to entail as an agent, if you're partnered with a great lender that can explain that, loop them into the conversation, have it be an open conversation where y'all can review the options with the buyer ahead of time so that they can make the best offer that they're comfortable with. With that, another thing that we recommend is do an in-depth CMA because ultimately as agents, we're the ones who are suggesting offer terms to our clients. And if we are confident in those offer terms, should an appraisal come in low, then we have an opportunity, or should it look low on paper and through the process we're about to dive into, we actually can speak to the appraiser. I think that another myth that I was under the influence of being a newer agent was that we are not allowed to talk to appraisers, that they go give their opinion and that's that, and there's no conversation to be had. But it's actually, I've learned that it's much different and things have gone much more smoothly for me since then. Because at the end of the day, we're all human and sometimes things are overlooked, and being able to have that dialogue with one another goes so far. So I think explaining the risk, setting the expectation, looping in a lender up front really is going to put your client in the best scenario. And also on the list side, if you do get that document, I think that it's important to, just like we vet pre-approval letters that we receive, if we receive an appraisal addendum, it's important that we call the lender and speak to that as well. Hey, we see on this, they checked box B, worst case scenario, there might be a 20 grand difference here. Does this client have that money? Do they have the options? So it's not only a form that we need to protect our buyers for, but our sellers as well. So just call the lender on the other side of the deal if you're a listing agent, talk it through and make sure that everybody's protected so that we can all have the smooth transactions that I know we all pray for every time we go under contract. Okay, so with that, we're gonna move over to the Tidewater procedure that we started to speak on. I think as real estate agents, it's important that we understand that we can have a proactive discussion with appraisers. So for instance, just yesterday, I actually had this come up with the appraisal shop. I was looped in an email with the lender, the listing agent, I'm representing the buyer, so myself and the appraisal shop, and we were asked to submit our best 3 comps. So Josh, you've done a really great job of teaching me about the Tidewater procedure, but I really appreciate the ability to discuss comps with an appraiser on the front end rather than on the back end when, like you said, the appraisal is certified and in the system. So could you talk about that a little more, Josh?
Yeah. So, you know, when this first, Tidewater has been around for a very long time because it's what VA loans have always done. Lauren, I'm not sure exactly when y'all officially started this with y'all's firm, but I want to say it's been 3 to 5 years. And I know when it first came out, I think it really made agents nervous. They're like, wait a minute, I'm not going to do the appraiser's job, right? They need to go figure it out. You go find the comps. So that was kind of the first, I think, initial reaction. Then they're like, well, wait, you know, we don't want to give our best comps because we really don't think it's worth that much anyway. So we want the value to be lower. So there's a lot of, there was kind of both sides of it. There were, you know, with utilizing this policy. What I like about it is when I tell every listing agent when I call, and I tell, you know, all of our agents that we work with, it is the best way to get our buyers and sellers to closing. And it is the best way to get the best appraisal, because we all know there may be stuff that the seller's done to the house that we don't know about ahead of time. Let me back up. You know, people ask, well, hasn't the appraiser seen the house? This is prior to the appraiser even seeing the house, right? We order the appraisal within 24 to 48 hours. They pull some comps and call it 20% of our loans. They're like, wait a minute, we need some help. We need to get some guidance. So this doesn't happen on every deal, but call it that 20%. They've not seen the house other than pictures online and the comps they pulled. So then they reach out to buyer's agent and listing agent together with us on there and say, give us your best 3 comps. Maybe you have an off-market listing, or maybe there's a sell across the street that's closing in 2 days. And you know that when that thing closes, that's going to be a comp. Or maybe the seller did some crazy, awesome upgrades that really didn't reflect in the picture. So it's your time to have your voice and to share what you think and your opinion. And I will tell you, 90% of the time when we have Tidewater, it comes back making value. Like it doesn't mean just when we have a Tidewater, the debt deal's dead and we're done. So in most cases, this helps the appraiser get to where we need to get to. So I find it's one of the best things. And I really think Appraisal Shop is one of the few other than VA that do this. And it's an awesome, awesome way to get us to that final appraised value.
Mm-hmm. Lauren, would you mind jumping in and telling us what information you appreciate having from the agents when this email is sent out? Obviously, it's an opportunity to maybe share a bit of our opinion, but how far do you like that information to go from the agent, and what are you really looking for as an appraiser during this?
I think that when Josh talks about maybe 10 or 20%, get these, you can imagine which 10 or 20% these are. New construction, right? New construction where the builder hasn't put everything in the MLS, so we get that. What about something that's 50K over list, where we're trying to figure out what are you really doing here? You really think it's 50K over list, or is it that you needed to put in the best offer in this multiple offer situation? So it really is a communication. When you start talking about realtors are the first point of contact from the market participants. So when you get a team together where a market participant picks a top 50 realtor, and the top 50 realtor is using a quality lender like Legacy, and then Legacy Mutual, because it's their business, knows that there's a local firm in town. And now you have a team of people that understand something as complex as a appraisal addendum and what exactly that means, because how many appraisers do you think look at that? Or how many that even if they do look at it, they look at it and say, oh, so they're willing to be happy at this number, so I guess that's my number, right? So unless you have a team working together, and this is part of the teamwork, this is letting everybody know you need to tell us what we're doing here, right? And so that we can then understand. And that's why Josh says that many times it helps us. If you can explain to me, I'm an appraiser, so, and I've done all kinds of appraisals. I'm a VA appraiser, so naturally we gravitate towards this. But I can do a $10 million waterfront estate on Lake Austin. I can go do a manufactured home in Apache Shores. I know how to do that. I don't know your neighborhood better than you. Sorry, I just don't. You can explain to me the HOA, how this neighborhood really is in this HOA, or this neighborhood actually, this part of the neighborhood's in a different school zone. Anything that you can tell us to help us, what we would really like, I mean, we don't want that 3-page response that starts off with, the seller has owned the property for 30 years and raised 6 generations and so on and so on. You don't need to do all that. I just need the comps that you think are your 3 best, and maybe a little bit about why you did what you did. A lot of times you'll be amazed. I'm sure you know not all agents are top 50 agents. And some of them just, they don't really have anything, right? So once that gets smoked out, then that maybe allows their seller to understand, hey, you told us you wanted to list it for this and we agreed to do that, but now we have to deal with the appraiser. So it really, sometimes it sucks all the emotion out of it early before you get to the closing table. If there's going to be a real connection somewhere along the line, we'd rather have it now than later so that we can see what's happening. But 3 good sales and maybe a little bit of information as to how you came to this or why these are the sales, perfectly good. And of course, we're still going to go back and talk to some people about it. But the Tidewater has a lot of functions, more so than just getting data. It's to get some clarity on the deal, and also so you can kind of tell us. Another thing you can do is, if there are comps that that are hurting us, for instance, collateral underwriter, which Josh is going to touch on, it's not a super smart thing. It looks at proximity. So if you know that the sale across the street is what's hurting us, and you know something about that sale across the street, you let us know. Tell us that, hey, this sale was under distress. It sold for low because of this. Whatever story you need to tell us how you got to where you're at and what you're trying to do is going to be helpful.
I do want to bring up one other thing that I think is important, that when we do this, the appraisal is put on hold. So the sooner that both agents can respond back, and we don't take it off of hold. Sorry, y'all. Oh, it's working from home. I lost my train. Oh, here. So the quicker you can respond back, right? I mean, so I tell everyone, when you get this email, get us back something that day, because we can take the appraisal off of that hold status. Because I've had it times where people haven't responded back in days, and then now the appraisal takes an extra week to get back. So it's important, when you get this, respond as soon as you can.
Yes, thank you. I was actually just about to bring that up with the email. It's on screen share right now for everybody, and this is being recorded, so you'll get a copy. But that final sentence of the third paragraph there does talk about that 48-hour hold. One thing in my experience of working with Josh and his team, anytime that I do go in over asking, I anticipate that this could come up. Ultimately, I never want a buyer to overpay, obviously, and there's a reason that I'm guiding on the offer price that I am. So to save time in real estate, we never know what's going to come up from day to day in our lives. Just have these 3 comps prepped and ready to go if you think it all in your mind that this could come up in a transaction. Another thing I want to piggyback on there that is something that I just recently learned as well. I was working with a lender that they have multiple appraisers that I guess they send their work to, and as agents, we do have a voice in that matter as well. And I think that that's so important to know. So I was able to speak with that lender and say, hey, who are the appraisers that you work with? And then Appraisal Shop happened to be one of them. And I said, that's who I would prefer that this one go through, because it's in such a unique location of Austin. I know they've done work there before and they understand the appreciation rate there. And the uniqueness of the properties and the value on lot size specifically. And they said, no problem. They made sure that on their back end, it went through Appraisal Shop. And we got the email, we sent in our comps. I prepped the other agent for it because sometimes the first time you do get this email, it can be a little worrisome and you automatically kind of get that pit in your stomach of, oh no, this might not make value. But really, this is a proactive approach to help you make value. So I'd say just keep those 3 comps in your back pocket ready to go so that you can answer quickly and keep the deal moving to closing in a timely manner.
Can I comment quickly, Nicole?
Yes.
So the one thing that you're saying about that, obviously you cannot pick the appraiser, but because Appraisal Shop is a firm and we handle the management services for Legacy, it can come to us and then we pick the appraiser who we feel is the most appropriate one. So if this is really a problem for you as an agent, you'll notice down at the bottom that you can tell Legacy and say, hey, look, these guys are completely off base. There's no reason why they would ever have sent this to us if they know what they're doing. We want you to go to a different company. Legacy, they're not going to want to do this, but they can at this point. Once you get an appraisal, they can't. So this is a way for you, if you just don't like Appraisal Shop, we don't want you to be stuck with us, nor does Nick or Josh. For them, we're their best option, but you do have the option here is all I want you to be aware of. You can say, we don't want it to go to them. It's not going to hurt our feelings. We want it to work out for you. That's what's most important to everybody.
Yes. And ultimately, I mean, yeah, every deal, we always need to keep that top of mind, that we're in the business of making 2 parties happy at the end of the day. So while we have a fiduciary to one, we need to be proactively working together to help move things along. So for instance, this week, I mean, on my deal that came in, both myself and the other agent are on the email chain with Appraisal Shop, sharing the same values that why she priced it there and why I recommend offering there. So always keep in mind the goal of real estate is to get transaction closed and make 2 parties happy at the end of the day. So we'll switch gears.
Came in about changing value. If y'all are answering questions, I don't know. I don't know who's doing that.
I think that Amber's going to pop over to the Q&A at the end of the session for us. So we'll switch over really quick. I know that this topic comes up quite a bit, is adjustments on unique features to a property. So a barn, a workshop, solar panels, gutters, pools, anything. Maybe we'll start with the myth that pools will never be valued more than $15,000 no matter how nice they are. Can you share a little bit about that and some experience that you've had with much higher value pools on an appraisal?
Absolutely. Thanks, Nicole. So I know there has been some appraisal teaching out there that there's some static amount for a pool. Also, there may be a misguided idea that only appraisers know these things, that we have some sort of secret appraiser book that we can look at that you're not allowed to see. That's not the case. All of the agents can do this just as easily as we can with your CMA. It's not a dollar per square foot process that the banks do. They like the unit in place or this CMA type process that you guys have. So we've put our screen up here, and ours is a little more complicated only because it has things that you don't need to look at, like leasehold, fee simple, or any one of these things that doesn't matter to you in terms of functional utility. If everything has central heat and air, you don't need that. So you can have a more small CMA that only has the 5 or 6 things that are important. But if you'll notice here at the bottom of that page, you'll see 3 numbers, 445, 415, and 445. Those are the adjusted sales prices of the comparables. So those are the ones, and Maggie's asking about casitas and buildings, which would be the same thing. It doesn't matter what the feature is, you can use the same process. The only way I can give value for something is to market extracted, meaning I have a comp that has that feature or a similar feature that I can say is similar. In this case, pools are fairly easy. So what you'll see here is those 3 numbers at the bottom are the indicated sales price. These are what are pointing to the subject to say, this is what the subject should be worth, because after I've adjusted comp 1, comp 2, and comp 3 for any differing features, these numbers are telling me what my property should be worth. So what you'll notice is comp 2 has a number of 415 at this point. And I'm sure anybody can look at this and say, well, why is comp 2 saying 415 and the other 2 are saying 445? It's because if you see that yellow spot, the other 2 comps had an in-ground pool, whereas comp 2 does not. So we will have to add an amount of money there to show what the contributing value, how much is the in-ground pool adding to the value of the subject in those 2 comps. It's the contributory value. So if y'all want to use language when you are talking to a different appraisal firm or us, or contributory value is a good use PAP language you can use. In this case, Alex, why don't we put in $50,000 for the pool? If you put in 50,000, you've ran that number up past the other 2 numbers that had pools. So it doesn't look like 50 is correct. So what would be a good number here? Your call, buddy. 30K. Now this is obviously obtuse and very simplified, but this is how we do it. This is how we decide what the pool added. And the only way to do that is to have a comp with that feature. And so this is where you might run into problems where you talk about over improvements and things. I recently was doing an appraisal in a neighborhood where there were no pools. It's a fairly new neighborhood. Nobody's put in pools yet. And somebody spent a lot of money to put a pool in. So that gets more difficult. If that's the case, you're going to need to go to the next substitutive neighborhood where you can find a pool. That's another word you can use when you're talking to appraisers. This neighborhood is substitutive with this neighborhood, and they should take your advice on that, and especially if you can explain why.
Awesome. So I see the chat box going off quite a bit on this topic. I'm gonna let y'all keep going on this. Josh, I think that there's a little bit more to this subject if we need to use anything, if there's pending or active that does have that feature possibly.
Yeah, I was just curious. I mean, you know, people ask, hey, we have a pending sell or, you know, a listing. How do you utilize that on the report? I also get the question too, well, there's 19 offers on the house. How do you reflect that in an appraisal? So just curious about those three things.
Absolutely. So one thing that an appraiser should let you know, and this is another thing about the conversation. So let's say we send out the Tidewater and they come back and they say, well, there's this pending sale down the street. Well, would you like to wait for that pending sale to close? Would that be a good strategy here? And if we did wait for it to close, would it help our cause? So it's that kind of consulting relationship that happens when you're working with the best in the business who understand and work together. So something like that, is important. So your other question, so a pending sale will be taken into account, but of course, if it hasn't closed yet, it can't be weighted. And I can guarantee you the banks aren't going to want it on the first page. So it's not going to be weighted as heavily as a sale. So you might want to wait for it to close. And another question?
It was, well, a listing too. Like, hey, I usually notice comp 5 or 6 that you use as a listing. I assume that's just to show kind of what's happening, what's being listed now, what's happening, now.
So one of the challenges,
that listing on the appraisal.
I think it's valuable, and I think one of the challenges for all lenders is that you have multiple investors and multiple guidelines, and some investors require that and some do not. And so the appraisers will throw that on there to try to make sure that you can move this loan to anywhere you need to go and have everything that's there. I don't prefer our appraisers to put more than 6, meaning 2 pages, because there's an old school underwriting idea. If you don't have 3, you don't have any. So about the time you start putting 9 comps in, you're beginning to aggravate an underwriter. But that's another thing about working with banks and lenders that have a firm where the appraisers are all, in my case, employees. So they see these underwriters, they see our reports over and over and over, and they're not scatological in the way that all the other appraisers are independent contractors and they got their own way of doing things. These underwriters become very, very familiar and comfortable with our formatting and how we do things, like adding all the comps in so that if they need to move it to a different investor, that everything they need, and it's all gotten up front. And so anyway, there's a value to it in working with realtors that that you trust. I think that the adults in the room help keep the market participants from going completely off the cliff on some of these things when it's so undersupplied as it is now, and people are panicking and they want to get in a house. I just think that strong, calm guidance is an important thing, and that's why you guys are the top realtors in the business.
So what about the hey, there was 10 offers on this? Where do you even show that on an appraisal or comment about it? Because I get that a lot, like, sorry, I know we went 50,000 over list, but there was 10 offers.
It's definitely valuable. Oftentimes when they talk about 10 offers, realtors, and I'm a broker and I know you don't have 10 offers in hand. You had 10 people, or you might, I get it, but there's only so much of that. The appraiser should reference that in the offering section, which is right underneath the very top where you have the contract and the offer. This was a multiple offer situation, and they might ask you to provide a couple of them, and that certainly helps. But if that was all it took for a bank to lend, then we wouldn't do anything, right? We would be fine. We could just say there's 10 offers, so it must be worth it. What they want, though, is the closed offers of comparable sales. So even though that may allow an appraiser to be aggressive in where he goes in the range of value, or it gives him confidence, it doesn't necessarily fix it to where it'll make it through an underwriting review, right? So we still have to go through our thing and say, well, if that's the case, where are the sales? And so this kind of thing only happens in a place like Austin, where the undersupply is causing a certain amount of speculation and a certain amount of panic. And the lenders are not going to lend on that. They want something solid. So you got to remember that it's their money, and they are very, very good at collateralizing. And I'm not talking about the bank level guys like Legacy or anyone else. I'm talking about where this money flows to, the regulators and the big lenders, OCC, Fannie Mae. And in the end, JJ, Josh, and Nick are both responsible in the end, as am I. If this thing gets out and goes down the line 6 months from now, and some Fannie Mae QC guy decides he doesn't like the way we put all our eggs in this one basket of multiple offers and buy it back. And that is the worst thing that can happen to me, my appraiser, and the lender possible. So you got to remember, you're borrowing money. It's not a right, it's a privilege. You got to kind of play by their rules a little bit.
Yep.
Nick, did you have any follow-up on that or anything about the adjustments, or?
Just, I guess, a question, because I think a lot of people still say, well, what's the value of a pool? Is the simple answer just to say that the value varies from year to year based on the recent sales of homes with pools?
I think yes, but also I saw that question, and so there is no, you cannot do that, because you can imagine that there's a one line item for pool, like it's $20,000, right? That's the,
Uh-oh.
We lose Lauren.
We might have lost him for a
So,
moment. Oh, there
Cat
he is.
Hollow, and this smoke rents me. Am I gone?
You're back.
You're back
Yeah.
on, and it's the most popular question, so we'll need you to tell us again.
Can you imagine the difference between the value of a pool in Cat Hollow on an income producing 1,600 square foot 3.2 built in 1982, and the value of a negative edge pool in Escalara or Amara or Lake Austin or Lake Travis? If you don't have a pool on that 7,000 square foot waterfront house, it's actually a negative functionality of not only the cost of the pool, but the fact that nobody in that price range is going to retrofit a pool into their backyard. It could be $500,000. When we see really, really high dollar new construction, and they're like, yeah, we're going to do the pool later. We're like, now you can get a different appraisal company because you're not going, we can't do it. We can't find a comp. In that kind of resort property that doesn't have a pool. And the amount we're going to have to ding you for that is going to be astounding, because when we go out and try to find a comp with no pool, it drops substantially from that multi-million-dollar range. So it really has to do with the property and how it fits with the property, and you need comps. The comps are going to tell you. You cannot dream up a number. That is against the standards of our practice because it's not reliable.
So is it helpful, let's say that we have a client in a neighborhood where pools, it's not a neighborhood like that where they're pretty much a must-have on your appraised value. Is it helpful if they have all the information on their pool, the specs to their pool, things of that nature? Because of course we have the sellers that we go to and say, I have the best pool in this neighborhood. I spent $250,000 on my pool. And then we have to explain to them, well, on an appraisal, we anticipate the return on that investment is going to be X. Is it helpful to have that documentation at all, or it's just
it's kind of like saying, my shower heads are made out of gold and this and that. The pools. So, but there were two good questions in there. They say, how do you determine the value of the pool for a listing? It's with the CMA, with the process that we're showing here, where you actually find the two best comps that are most similar to you that have pools. If your problem is that you don't have pools in the immediate subdivision, you have to be truthful with yourself. Is it that you don't have pools in the immediate subdivision, or that the comps with pools in the immediate subdivision don't tell you what the seller wants to hear, right? But if you truly don't have any in the subdivision, you need to go to the next substitutive neighborhood and get the most physically similar house in the most substitutive neighborhood that has a pool, and put it in your CMA, and adjust for all other things the way you know how to adjust for them, the things that you're used to adjusting for. Let's say you do 10,000 for a garage, or a certain dollar per square foot, or a certain amount for a bath. Do all those things first, and then you have that one line item. And it doesn't have to be a pool. It can be a workshop. It can be a casita, like they asked about previously. But if you think you're going to come to a value for contributing value of any feature at all without actually pulling a comp with the same feature, you're just, at that point, you're doing what an agent can do, which is give a price opinion, and then you put it on the market and you get the contract, and then you worry about the appraisal later. But an appraiser can't do that. We have to prove it. We have to prove it in the report.
What about another hot topic too? Because I think that we've touched on pools as best we can to answer the questions that came in. There is a lot of, on real estate forums, a lot of conversation about solar panels, and there have been for years since they've come out. And the most common answer that I see is appraisers do not give value for solar panels. I see it 50 times on one thread. Is that true, or is that another myth that you could debunk for us?
That's incorrect. And if they're not, then they're not doing it right. Now, there could be a difference in market areas where, like perhaps in California, they're rented. Because sometimes you'll get underwriters that are like, hey, we need to know that this is owned. In Texas, it seems to me like they're always owned. But there's a complicated way to do this. We presented for the DOE in Washington, D.C., Appraisal Institute, Fannie Mae, HUD, VA on green appraising. And they liked the way we do it. But one thing you can do, and it's very easy on the internet, is go look at a present value formula. And it's very simple. What it is if you truly have good solar panels, you should have something that you're getting that says how much you save every month, right? Either a HERS report or something from the city that's saying we're buying back this much energy from you months or whatever. If you can show a cash flow every month. And this is the way you should do it to start as a listing agent. And you take that cash flow, it's a present value is a series of cash flows that you're going to get into a certain amount of time at a certain rate. And so what's that worth for me today, right? It's kind of like if you hit the lottery, whether you want to take it all at once for the big number, or if you're going to take a series of cash flows down the road and get an even bigger number that way. So what it is the risk of waiting for your series of cash flows makes it where your present value is a little lower. So the way this works is you would put in with a present value formula on the internet or any kind of calculator, you would put in how much you save a month, how long you have on the solar panels, in like 10 years, right? So that would be 10 years times, you know, the period times 12, so 120 periods, right? And then the interest rate or whatever rate you want to use, which I would use your interest rate on purchasing, right? So interest rates are 5% or whatever they are. If you do that, it'll give you the present value of having that flow of cash. And that would be your start for saying, okay, this is what we think our solar panels are worth, because we're going to save you this much money for all this time. And the functional present value of that is $12,000. So you can start there. Then when you can give that to the appraiser, so they're kind of looking at that and seeing that, and then they're going to go out and do just like a pool, find a comp somewhere that is the most proximate and similar sale, adjust for all other things, and hope that there's some sort of boost or contributory value shown by this comparable that had solar that supports something in the neighborhood of $10,000 or $15,000.
Perfect. I know that was a lot of information, but keep in mind this is recorded, so you could just fast forward to 45 minutes in and get that rundown again if you need to. I see a lot of great questions coming in on the side also that we'll hop to. So we'll get on this last, there's two more topics. We're going to run through that AI technology in just a moment. And then we're also going to talk about prepping for an appeal. So you've already shared some great appraisal lingo with us, if you will, about substitutive neighborhoods. I took down a few notes myself, the contributory value, different things like that. Could you tell us just a quick 1, 2, 3 of how we can prep to appeal an appraisal, unfortunately?
Well, I think, so that happens in a reconsideration phase. And like Josh explained, once an appraiser has signed a report and come up with a value, when this reconsideration thing came about after the 2008 meltdown, when the AMCs came out and all the appraisers got scattered into little individual independent contractors. And so under the guise that they were not going to bully the appraisers anymore, they became even more bullying, which is after the fact, we're going to tell you you need to change your value. And that's very bad for an appraiser, because on one point he's saying, okay, as of yesterday, it was this value, but now I must have made a big mistake. And so this day it's changed. Now, if that's not evidence of being coerced, I don't know what is. That's why we did the Tidewater, because we want it out in front. So we don't do very many reconsideration. How many reconsideration requests do you get, Pronsky?
Barely any.
Yeah, none. And if we make a mistake, if an appraiser makes a mistake, they should change their value. If there's
the only time that
find a mistake in the report. That opens up the door for you to be able to go in and say, you know, if there's a legitimate mistake, and I find a lot of mistakes in a lot of reports that we review. So I think you could find a mistake. Certainly, if there's an inconsistency, if you can find anywhere in the report where you can see where the appraiser has not gone the distance to do what he should have done, certainly if they didn't use the proper comps, I mean, if it's not clear in the report how they come up with their value, you want to show, I mean, we could show you bad reports and I can show you stuff to look for. Across the board adjustments or across the board non-adjustments, where an appraiser says, a perfect example would be the solar panels, where he says he doesn't give them any value. That would be incorrect. That would be incorrect. And you would have to say, you have not, I don't know that they want to see this, but I don't know if we need to get into all that. But certainly, if you can find an error, I think that is a factual error is your place where you can start. And if you can see where they haven't made it clear how they come to this value. For instance, if their indicated values show 450, 475, and 525, and they say that the number is 450. Why is it not 525 then? Why is 450 of that range your number? right? Some guys just like to round down. I mean, I've caught my guys doing it all the time. I'm like, why are we rounding down here in this market? In this market, you're going to pull the smallest number. So if it's not clear how they come, if you can't understand the report, it is absolutely fair to ask for an explanation. And certainly, if you can find an error, a factual error that would make a difference, then get your, honestly, I'm available to talk to any agent that want, it doesn't matter if it's one of our deals. If they're a market participant, somebody that, it doesn't matter to me. I'm happy to help them with any of this stuff after the, I'll put my number up there, they can call me.
Perfect. That's very helpful. So agents, it sounds like if there's a factual error that you can find, that's your first step to start an appeal process and bring that to your lender's attention. Let's jump over really quick. Josh and Nick, could y'all talk about what we were discussing before this started, the AI technology? And then also, can you hit on drive-by appraisals and appraisal waivers? So a lot, but if you can throw that in there, I know that we're getting close on time.
I'll do the AI thing, and then Nick will do the drive-by stuff. So AI, it's called collateral underwriter. So for the past 10 years, every appraisal that we do that's a Fannie Mae, Freddie Mac loan, once we get the appraisal, we have to run it through this system, and it scores the appraisal. And it scores it between 1 to 5. 1 meaning no risk, 5 meaning high risk. And this scoring, I mean, it looks at everything. It looks at other appraisals that were done in the neighborhood, why that appraiser used that comp and did a line item adjustment for the pool for 30,000. Why did this pool adjustment for the same comp do 40,000? Like, it really goes into it. And if we get a score, above 3.5, we have to get a second review, meaning our appraisal underwriter will review it and maybe go back to Lauren and say, hey, can you tell me why we did this? Or can we add an additional comp that was closer to try to bring that score back down? We almost, we're trying to bring the score down, because the issue is, it's not that we don't agree with the value. The issue is when we close the loan and we have a score of a 5, no lender really wants to buy that loan from us. I mean, we've had 4 lenders in the past month say, if there's a score of a 5, we're not even buying this loan from us. So it's really changed just in the past few months. So, what'll happen is we either review it, Lauren makes us changes. There are times we have to get a second appraisal done, or an automated valuation done. So there's just other things that, just because we get an appraisal back and it meets value, doesn't mean we're out of the woods yet. And this is across the board, not just Legacy. This is all lenders, big banks, small banks, anyone selling to Fannie Mae, Freddie Mac. We're all following the same scoring system. But we don't want to scare people and tell people every time, hey, this score got a 5, because it freaks some people out. But we have to let you know that there's a chance we have to get, a second review done. I have only had it in my career in 17 years. I've had 2 where we had to get a second appraisal, and the second appraisal knocked the value down. So out of 6,000 loans I've done, 2 have had a second appraisal, knock the value down. In most cases, they support the value. Mm-hmm. Nick, would you agree?
That's exactly right. I've had 1. Yeah.
And Nick, will you talk about those appraisal waivers and the drive-bys right now?
Yeah. So with everything that's been happening with the economy, with COVID-19, we're seeing a lot of allowances from Fannie, Freddie, and Ginnie Mae. And so what they're doing is they're freeing up some flexibility from an underwriting on what is acceptable for an appraisal. So the first thing we do as a lender when we get a contract is we input the address into our origination software. We run it through what's called an automated underwriting system. So we either use DU, Desktop Underwriter, for Fannie Mae loans, or LP for Freddie Mac. And so we run it through this system, and it spits out an approval or a decline on the loan. But when the approval comes out, we read it, and there's a section for the property. And on conventional loans, if you have at least 10% down, or on a refinance, if you have 10% equity or more, on a case-by-case basis, they will, like Josh mentioned, they'll look at all the data that they have behind the scenes, and if they're comfortable with the value as is, they will say this loan qualifies for an appraisal waiver or a property inspection waiver, to where we don't even have to order an appraisal. We're seeing a lot of those right now. When we get those, we're not required to use them. It is the borrower's choice. So we will go to them, 99 times out of 100, they're going to say, oh, that saves me $500. No, I don't want to order an appraisal. Let's take the waiver. But sometimes if they went under contract, maybe with the hope that the appraisal would come in low so that they could renegotiate the price, they don't have to use that appraisal waiver. So in that case, we can still order one if the buyer requests it. In addition to appraisal waivers, in a lot of loans, let's say there's an instance where either the appraiser is uncomfortable going into a certain house, or more common, the homeowner is not comfortable allowing an appraiser into their house just due to concerns. In those cases, depending on the loan and the down payment, a lot of times we can allow an exterior only drive-by appraisal or a desk review in that order, ideally an exterior only report. And so when that happens, keep in mind, whether you're a buyer's or listing agent, in that scenario, how will that impact your value? How important are the upgrades in the interior of the home? And will it benefit you or hurt you to allow an exterior only report or a desk review? So that's the only like advice I would really give on that topic as far to realtors. But the general theme is that there are alternatives right now to full appraisals because of the climate we're in, and both Fannie, Freddie, and Ginnie. So we're talking FHA, conventional loans. We're seeing a lot of different alternatives on how we can appraise homes right now.
Perfect. Well, thank you all. I see some questions. I'm going to let Amber hop back in. I know she's going to help moderate. The questions came through. One that I do see over here, Lauren, is how do you differentiate between builders? How do you assign different value to a house built by one builder versus another?
So obviously that's going to be a case-by-case basis, but the ideal thing would be to use your comps from the same builder. And then it's kind of like you're going to stay in your subdivision until you have to go out. Now, there is some old school underwriting where they say, well, but we want one from a different builder. And this comes from a time before the MLS and where builders could just feed you paper comps. And so they wanted one from somebody, a disinterested party as well. I don't believe in that. I think, you know, your best comps are coming from your builder, but you can't always get everything covered with your builder. For instance, let's say your house is a little bit bigger than the rest of the homes that builder's building. And so you're going to use your two comps from your builder, and then you're going to go get one from a different builder that's larger. Generally, they're going to be in the same quality. You're going to maybe make adjustments for upgrades, and it's going to be based on you looking, and if there's no photographs, it gets tough, right? So you have to kind of look at it and determine, does it look like this builder per square foot or overall price is less than ours typically, or more? And so again, it's just doing the CMA and seeing, once you've done your adjustments, if that third comp is sitting up there, you're going to have to, or below, if it's sitting low, let's say, you're going to have to go in and figure out, why is this comp by a different builder not supporting the indicated values that the comps by my builder are? Is it because that this builder typically doesn't have as nice upgrades, or maybe there's things you can't see, energy efficient things, spray foam in the attic, whatever they're doing. The appraiser needs to make themselves aware of these things before they plan to value, particularly if they're going to be contrary to arm's length purchase price. Now, I can tell you one thing you need to be aware of: builder contracts, okay, these are not necessarily meet the definitions of an arm's length purchase price, right? These are, you know, we want to put in this and this and this and this and this. We want to put in this and this and this. That's more becoming a cost issue, and those are where we see a lot of problems. But typically we can make them work.
Awesome. Y'all, this has been so great. And just out of respect for that, we said it would be an hour webinar and ending at 3. For anyone that has to go, I want to thank you. We're going to stick around and answer some more questions so you don't have to go. But for those that are on the call and need to, thank you so much for supporting Platinum Top 50. Thank you for valuing this content. And I'd be remiss if I didn't, close by thanking our partners at Legacy Mutual Mortgage for the continued support and just the professionalism that you bring to the industry and the value that you bring to the agents in our network. So that's it for like the formal, closeout. But again, we've got some questions to work through. So I'm not going to end this just to end this. So let me ask one, and I'm not sure who to ask it to. So if you want to answer, just raise your hand. So Heather Brown wrote, can someone speak to what being in a floodplain or partial floodplain does to value?
So it's just like anything else. If you're going to find out what being in a floodplain does to you, you're going to need to go find a comp that's in the floodplain. But Obviously, the degree at which you're in the floodplain is going to be an issue, right? So if it's your improvements that are in the floodplain, obviously, if it means that you have to pick up flood insurance, it's the same thing as we were talking about previously with a present value. How much is it going to be worth to you to pay $50 more a month in flood insurance for 30 years at a certain interest rate, right? So you'll find that properties that are in the floodplain now sometimes the floodplain is something that's a good thing, right? It backs down to Barton Creek. It doesn't flood your house. It gives you a view. So you kind of want to determine how the floodplain really affects you. Does it mean you can't build on the property anymore? You can't do certain things to your house? Different floodplain issues are different. On Lake Travis, you're always in the floodplain, right? But your house may not be in the floodplain.
So one more question from the Q&A for Lauren. What rooms are counted in total room count?
That's pretty tricky. You're talking about ANSI measuring standards. I don't understand why they like to clip rooms. Obviously, in the total room count, you're not counting bathrooms. I don't know why, but they don't. So your bedrooms, any living room, dining room, and then kitchen. So a typical room count for a 3-bedroom, 2-bath house that has a kitchen, living, and dining would be 6. They don't let us count foyers or utility rooms. Honestly, I think if it's a gigantic foyer that's, with the grand staircase, I don't know why that's not a room, and I think utility rooms are rooms, but we just do it apples to apples, right? So that if I'm not counting this room for my sale, I'm not counting it for the comp. But basically bedrooms, living, and dining.
And lastly, a new one came in from Gabriella. Can you use a comp? Can you use as a comp an identical home sold 9 months ago with other comps?
Yes, we go back a year. And that's where the cutoff is for Fannie Mae.
Awesome.
When I do other really complex stuff, I'll go back 3 years or more if I have to. But for the purposes of what you guys are doing, it's 1 year. You can put an older sale. Let's say it was something that sold 366 days ago, but it's just a perfect comp, right? We'll put it on the back page, kind of like a listing or something. We'll factor it in and we'll explain that we think it's a factor, and it's on the back simply because of underwriting. So if you have a really, really good comp, be sure, I wouldn't make a fuss about it, but I would let it be known that, hey, this comp is a little older in a year, but we think you ought to look at it.
That's awesome. Like, such great advice. Nicole, is there anything else that you have to add before closing us out?
I think that I'm good on my end. There's a few more questions that I see over on the sidebar, and I know there's a never-ending list of questions when it comes to appraisals. So maybe we could gather those. Amber, I don't know if that's something we can coordinate. I see a few over here that I see come up often, and we could send them over to Lauren for review and maybe shoot it out. Or
I don't mind staying up and going through the questions if you all want.
Yeah, you put the same questions in the chat.
Perfect. I see one, the valuation. Let's say that a house is 25 years old and one of the comps has a brand new roof and the house that's being sold has the original roof. Does that have any valuation to it?
That's a tough one. I don't think we would try to, clip or lower. Remember, the appraisers, if they're smart, they're looking at the market value. In other words, today you have these market participants. We look at the arm's length contract price, and we're just trying to come in behind and say, this is plausible and reasonable and meets underwriting standards if we use these comps. If we found that for some reason, I don't think that they're going to make an adjustment based on roof age. That's kind of getting out of the pale. There's not really a line item for it. You could get into overall condition of the house and say, hey, I'm a C4, meaning I'm only in average condition because I have an old roof, and that's a C3, and that's why it's sitting up high. It's somewhat of an art form in that we're trying to put something forward that everybody can understand and get on board with, and not put something out there that is a problem for underwriting and making adjustments for every possible thing we can see that we haven't really market extracted. So if there was market evidence that newer roof in that market contributed, I think you would need to recognize it.
Okay. Well, I have a question. Do you make adjustments for a condo based on what floor it's on? even if for a smaller, say 3 to 4 story building? That's a question coming in from Christina.
I think it would depend on what that floor level contributes to you. Because if it's giving you a view, then it becomes a view issue. In certain buildings, when you're in, let's say, for instance, the W, and you know for a fact that each floor level has a certain premium, then you can do that within that regime. But then you can't necessarily go across to the 360, which is 500 stories even higher, and start doing it. It doesn't translate. So you could make that adjustment. Again, it needs to be market proven. If you're showing that, if you've got a contract on a property and you're at the upper level, and that's giving you some sort of extra contributory value, then you would hope that you'd have a comp on that level that shows it.
Mm-hmm. I see another question over here too that comes up often. There's nothing like being an agent and going into a house that was listed as a 4-bedroom and it's a 3-bedroom with an office. So what is your definition of a bedroom? Does it need 2 points of egress, such as a door and a window, or does it need those 2 points and a closet?
Hey, I learned something today. 2 points of egress. I like the 2 points of egress. So obviously and that's true. Obviously in West Campus, what qualifies as a bedroom is different than what qualifies as a bedroom in Barton Hills or something, right? But normally what they say is they want a closet. The 2 points of egress would be good. But also, a lot of times people will try to tell me that this room over here is a bedroom, and the bathroom for that bedroom would be across the entire building. So I'd have to, streak across to the other side of the building to get to it, right? So it's really just a functionality. What is the true functionality? If that's to be used, by all means, but a lot of appraisers are going to be hard and fast on that and want a closet and 2 points of egress probably would be your best bet.
Perfect. And I see another one about at what point in construction are you comfortable with an appraisal occurring? It says if it's not finished yet, how do you appraise?
So whenever we do new construction, we do it subject to completion. And for purposes of comparison, it's hypothetically complete. So if you complete it like you say you're going to, then it will compare to these 3 comps and the value will be such. And then Nick will send me back out to do a final to make sure you did what you were supposed to.
You can do the appraisal anytime. We can do an appraisal with just nothing being built. Some people think we have to be certain complete before we do the appraisal. Now, the more complete it is, I think we get a better, probably, appraisal. Would you agree?
Well, if Josh orders a custom deal where it's a piece of land, then he's going to provide me with plans and specs, and then it's going to be subject to those plans and specs. If the house is almost done and I can go out and measure it and take photos, but you need to, finish putting in all the counter, then it's going to be subject to repairs, which will be a list of items that I want you to finish up, make sure the utilities are on and functioning, finish up the flooring, and it'll be good to go. That's how it's done in the industry for the 2 different things. You can either do it per the plans and specs, in which case you're going to have to provide me all that so I know what you're doing, or I can go look at it and tell you what you need to do to have it up to speed. Either way, you can get the appraisal now and get moving. Maggie had asked about collateral. It was called collateral underwriter, Maggie. It's not real smart. It looks at location. Like, is it next door to you or something, and then you didn't use it, then you get a high score. So if you have something nearby that you need the appraiser to know should not be used, or is that he should be adjusting, and there's a reason it's sold low, that's a valuable thing that you can tell an appraiser.
This is so awesome, y'all. I am so grateful. Nicole, Nick, Josh, Lauren, thank y'all so much for sharing your expertise. Thank you for being so willing to come forth in this format and share that. That's one of the things that I love about the Platinum Top 50 community. Agents like Nicole, lenders like Josh and Nick aren't afraid to get out there and share what they know, no matter who's listening. And it's all about helping each other learn more so we can, serve our clients to the highest capacity as a profession. And I just feel really honored to be in business with such great people. So thank y'all so much. It's a killer webinar when, people hang on 10 minutes after, right, for Q&A, which just lets me know that we hit the mark on the content. So Thank you all so much for the preparation. Thank you for your willingness to share. And thank you for the continued support of Platinum Top 50 Agents. Go like us on Facebook. You can always rewatch this from our Facebook page, and we look forward to bringing you more content in the future. So Lauren, thanks so much to you as well for sharing so much.
Thanks, Amber.
Thanks, guys.
Bye, guys.
Thank you. Bye.
Bye.
Thank you.